Hi everyone, today we're talking about the market for loanable funds, which we already set up the other day. So today we're going to recap what this market tells us and play around with it a little bit. So to remind you, the market for loanable funds looks at the flow of financial assets throughout the financial system. So on the x-axis we have the quantity of loanable funds, so think of this in dollar terms, and on the y-axis we have the real interest rate, which represents two things depending on who you are in this market. The interest rate represents the cost of borrowing money for the borrowers on the demand side, and therefore there is a negative relationship between the cost of a loan and the quantity demanded. So here is the demand curve, which reflects all of the borrowers in the economy. Right. On the other side of the market are the suppliers of loanable funds, who we can think of as all the savers in the economy. And for them, the interest rate represents the return on supplying loanable funds, the return on putting savings into your savings account, for instance. And so there's this positive relationship between the interest rate and the amount that's being supplied. So these are the savers. And the interaction of borrowers and savers in this market is going to lead to our equilibrium interest rate and equilibrium quantity of loans made. So notice something interesting here. When the interest rate is high, then the demand for loanable funds is pretty low. And if the interest rate falls, the demand for loanable funds increases. And so as we move from left to right, the highest returning projects are going to be the ones that are funded first. So the borrowers who have really good investment ideas with projects that are going to yield really high returns, they're willing to borrow money when the interest rate is really high. And anyone with a project with a much lower rate of return would not be willing to borrow money. And so for high interest rates, we have only the very highest expected returns on projects being funded. And at the same time, when we look at the savings rate, we look at the savers that are willing to save their money when interest rates are low are the ones that have the lowest opportunity cost of putting their money in a savings account instead of spending it today on consumer goods and services. And it's only as the interest rate gets higher and higher that the people who have really high opportunity costs of savings will put their money into the market, into the banks, for instance. And so what this brings us to when we consider both sides of the market is that the highest yielding investment projects are going to be funded by sort of the cheapest loans, the ones with the lowest opportunity cost. And so this yields efficiency in our marketplace. Now let's consider some things that could affect this market that might change the equilibrium that we're at. So for instance, suppose that there is now some new technology that becomes available. Consider, for instance, the gain in prominence of the internet during the 1990s. Companies are going to want to invest in this new technology, and so they're going to have to borrow money in order to finance this new investment. So we're going to see an increase in the demand for loanable funds, all else equal. So at any given interest rate, we're now going to have a higher demand. So we can call that D prime. And so at the current interest rate, we're now going to be out of equilibrium in the marketplace. So notice at Q star, we had the quantity of loanable funds supplied just being exactly enough to meet the quantity demanded. But now at this higher demand, at the current interest rate, we're going to be out of equilibrium. So now the new quantity demanded is way out here, right? But the quantity supplied is still here. And so we have too much demand, too little supply. So how do the banks get more supply so that they can keep loaning out money to these borrowers? Well, they start increasing the interest rate that they're going to offer to savers on their savings accounts, for instance. And so now we're going to see an increase in how many people want to save money. And so we'll have an increase in the quantity supplied of loanable funds. At the same time, some of these potential investors are going to back off. They're going to say, if it's that expensive to borrow the money, then it's not really going to be worth it. And so some of those companies perhaps that would gain the least from investing in this new technology will actually not invest in it. And only the ones that are going to have higher expected returns from the investment will do so. And so we see quantity supplied and quantity demanded moving to meet up at a new equilibrium where once again we have quantity demanded equaling quantity supplied. Notice though that while we have a higher quantity of loans made now, the cost of a loan has gone up. So the equilibrium interest rate is now going to be higher. Now consider a different example. Let's consider the supply side here. Now remember, the supply side is made of any national savings and net capital inflows, so savings coming from other countries. And so anything that might affect either national savings or net capital inflows will have an influence on the supply here. So in the early 2000s, there was an increase in net capital inflows because we had money coming in from China, which was seeing a lot of economic growth, as well as the Middle Eastern oil-producing countries that had sort of a surplus of petrodollars from the oil industry there. And so what did this do? This acted to shift out the supply of loanable funds in our market for loanable funds. So we'll call that supply prime. And so again, this threw the market out of equilibrium. Whereas again, before we had quantity supply equal to quantity demanded, now at the current interest rate, we have a surplus of loanable funds, right? So quantity supplied increased while quantity demanded initially stays over here, right? And so banks find themselves with a lot of sort of extra money floating around that and not enough people wanting to borrow it. So how do they get people to borrow it? Well, they make it cheaper to borrow by lowering the interest rate on loans. And as they do that, we see amongst the borrowers more willing borrowers, right? As the interest rate falls, there are some projects that were not profitable at the original interest rate, but now they are. At the same time, savers are going to decrease their savings to some extent because they're earning lower interest on their savings. So that's a disincentive to save. But the movement of both supply and demand along their curves is going to lead to our new equilibrium, Q star 2, where now quantity supplied and quantity demanded are equal, right? And this is going to balance out at the new equilibrium interest rate, R star 2. So the final outcome is that we have, compared to where we started, we have more money being loaned out, right? And it's cheaper to borrow that money, right? And this is actually thought to have contributed to the housing boom in the US in the early 2000s that ended up fueling a housing bubble that eventually led to the financial crisis, right? So it became a lot easier to borrow money because there was all this extra money floating around. So cheap loans fueled an increase in investment spending, including investment spending in construction. Notice that in both of the examples we just did, the Q star, the equilibrium quantity of loans, increased, but the interest rate in the previous example actually went up, while here the interest rate actually went down, right? So either one can lead to more investment spending or less investment spending, depending on what's going on in terms of a shift in supply out or in, or a shift in the demand curve out or in. Now let's consider one more example. So recall again, the supply of loanable funds is comprised of national savings and net capital inflows, and that national savings includes both private savings as well as public savings, right? So what the government may or may not be saving. And when we consider public savings, that is the difference between the net tax revenue that the government collects and how much the government spends on goods and services. So the capital G in our GDP equation, right? And this could be equal to 0, meaning that the government's running a balanced budget. It could be positive, meaning that the government's running a budget surplus and therefore actually contributing to national savings. Or it could be negative, meaning that the government's spending more here than it's collecting in tax revenue. So a budget deficit would be the same as saying there are negative public savings, and in that case, the government is detracting from national savings and therefore the supply of loanable funds. So since the norm is typically a budget deficit, let's see how that affects the market for loanable funds and therefore eventually affects economic growth. So if the government starts running a deficit or a larger and larger deficit, as our government has done over time, then the supply of loanable funds shifts in, right? The public savings is negative, so it's detracting from overall savings, national savings. So we see supply shift in, we'll call that S prime. And now we see a disequilibrium. So at the prevailing interest rate here, the quantity supplied for loanable funds is now lower, while the quantity demanded is still out here at the original equilibrium quantity, right? And so banks, the financial system doesn't have enough money to lend out to this now relatively higher demand. And so what are they going to do? They're going to start raising interest rates in order to encourage some additional savings to come back into the market, some more supply. So we see that quantity supplied respond to higher interest rates, but at the same time we see potential borrowers backing off and saying, well, okay, interest rates are higher now, so my project isn't going to be worthwhile anymore at this higher cost of borrowing required to fund that project, right? And we end up at this new equilibrium where the interest rate is higher, right? So the cost of a loan is higher, and you see that the equilibrium quantity is now lower than it was originally, right? So what is happening here? What is happening is that the government is spending, right? Saving less, and that's causing an increase in the cost of borrowing. And so private borrowers, private companies, right, are now less likely to borrow money because it's more expensive to borrow it. So the impact is that the government spending is going to crowd out investment by private entities, right? We have a special term for that I just mentioned, and it is crowding out. So when the government spends a lot, it can end up crowding out private investment spending. So that big capital I in our GDP equation, that's actually quite important for promoting economic growth because it leads to investment in capital per worker, in new technologies. It makes our workers more productive. And if that investment isn't happening, then our long-run economic growth can suffer, right? GDP per capita can suffer. Now, there are two caveats to that concern. One is that the government could actually be spending money on things that are also promoting economic growth. So if the government is spending on new technology or infrastructure or education, it's going to lead to more productive workers as well, and therefore raise GDP per worker and thus GDP per capita. But if the government's spending it on sort of current consumption, payments to some households, certain individuals, then it's not going to promote economic growth in the same way. The other caveat to this is that when we consider what comprises the supply of loanable funds, it's not just national savings, but also those net capital inflows, right? Savings coming from other countries. And so as long as that's sufficiently high, which in the US it is, then it really combats some of this crowding out effect. And we might not need to worry about it as much as perhaps a country that is much more limited in this international source of funding for their investment spending.